Inter-fund activity occurs within the same government and includes services, reimbursements, transfers, and loans.
The CPA exam heavily tests classification and financial statement impact.
For this explainer, we'll be moving methodically through 6 strictly clinical, highly testable areas. We're covering core principles, the decision framework, 4 activity types, government-wide eliminations, application scenarios, and finally, exam focus. Mastery of these 6 areas is absolutely required for bar exam success, so let's get right into it.
Section 1. Core Principles, Internal Movement, not External Transactions.
We're going to start by anchoring everything to the foundational rule of inter-fund accounting. When dealing with this topic, we are analyzing operations strictly within a single governmental reporting entity. The Governmental Accounting Standards Board requires us to view the primary government as a single economic entity when we look at the highest level of consolidation. Because of this, the core principle governing every single question you will face is absolute. Inter-fund activity occurs within the same government. These transactions do not create or destroy total resources. It is internal movement, not external transactions. I need you to anchor all complex journal entries and simulation scenarios directly to this simple fact. If you move cash or assets from one fund to another, you do not increase the government's overall net position. You are simply reallocating existing resources internally across different reporting funds. And listen, it does not matter if the transaction involves a general fund operating on the modified accrual basis, utilizing the current financial resources measurement focus, or if it involves an enterprise fund operating on the full accrual basis, utilizing the economic resources measurement focus. A reallocation within the primary government changes nothing at the macro level. Total resources remain exactly the same.
Section 2. The Classification Decision Framework, a 5-step algorithm.
Because internal movement does not change total resources, your accounting accuracy relies entirely on proper categorization. The CPA exam tests conditional logic here rather than mere memorization. To secure your points, you must utilize a 5-step classification decision framework. This algorithm is going to be your primary tool for every single exam scenario, and you must execute it sequentially. Do not skip steps, or you will misclassify the transaction and apply the incorrect accounting treatment. Here is the framework. Step 1. Identify the transaction details and the specific funds involved. Step 2. Ask yourself, is there an exchange of value? If yes, the classification is an inter-fund service. Step 3. If there's no exchange, ask, is it correcting a prior transaction? If yes, the classification is a reimbursement. Step 4. If it's not a correction, ask, is repayment expected? If yes, the classification is a loan. Finally, Step 5. If the transaction fails all those previous conditions, the classification automatically defaults to a transfer. You must apply this exact logic uniformly to every scenario you encounter on exam day.
Section 3. 4 types of activity and their financial statement impact.
Once you classify the activity using that 5-step framework, you have to apply the direct accounting impact at the fund level for these 4 distinct categories. This matrix dictates the required journal entries, and the examiners will test you heavily on these mechanics. Let's look at inter-fund services. Here, there's a reciprocal exchange. The selling fund records program revenue. The purchasing fund, however, must record an expenditure if it is a governmental fund or an expense if it is a proprietary fund. You need to memorize this critical distinction right now. Proprietary funds operate on the economic resources measurement focus and use full accrual accounting. Therefore, they record expenses, never expenditures. Applying an expenditure to an enterprise fund is a guaranteed way to lose points on a simulation. Next up, reimbursements. This is strictly a correction of a prior transaction. Absolutely no new revenue or expense is recognized here. The fund being reimbursed credits its initial expense or expense to reduce it, while the reimbursing fund debits the proper expense or expenditure account. Then we have transfers. These are non-exchange transactions with no repayment expected. Governmental funds report these as other financing sources, transfers in, and other financing uses, transfers out. It is crucial to understand that these are reported below the line on the statement of revenues, expenditures, and changes in fund balance. They are strictly segregated from standard operating revenues and expenditures. We do this to prevent distorting the fund's actual operational performance. Finally, loans. By definition, loans require expected repayment. Therefore, they are strictly balance sheet movements. The lending fund debits a due from asset account, and the borrowing fund credits a due to liability account. Inter-fund loans are assets and liabilities only. They never ever impact revenues, expenditures, or other financing sources.
Section 4. Government-wide statement eliminations. The exceptions.
Fund-level accounting requires those detailed entries we just discussed. However, you must also prepare for the consolidation phase. Internal transactions generally vanish when rolling up to the government-wide financial statements. We do this to prevent double counting. The examiners will aggressively test your knowledge of the consolidation rules and their strict limits. So I want you to assess this specific, high-probability question. Which inter-fund activity is not eliminated on government-wide statements? Take a mental pause here and lock in your answer before we move forward.
Did you get it? The exception is inter-fund services. Inter-fund services provided and used are not eliminated. Why does this rule exist? Because eliminating them would misstate the functional expenses of the buying function and the program revenues of the selling function. Doing so would fundamentally distort the true cost of providing specific public services to the taxpayers. However, you absolutely must memorize one special case to this rule: internal service fund activity. Internal service funds account for in-house business activities provided to other governmental departments on a cost reimbursement basis, like a centralized motor pool or an IT department. Because they primarily serve internal departments, their activities are combined into governmental activities on the government-wide statements. During this consolidation, any internal revenue or expense is eliminated, effectively removing any internal profit. If you do not remove this internal profit, you will double count revenues and artificially inflate the total net position of the primary government. Showing only the true external costs remaining is paramount. Teach this to yourself as a special case, clearly separate from the general services rule. And remember the primary baseline. While services survive, loans, transfers, and reimbursements are always eliminated.
Section 5. Application Scenarios for the City of Fairmont.
We will now systematically apply our 5-step decision framework to 4 specific City of Fairmont scenarios. As we transition into this, I am restating the core principle. Interfund activity occurs within the same government. These are internal transactions, which means there is no change in total resources. Scenario 1. The City of Fairmont Enterprise Fund bills the general fund $30,000 for water utility services. Let's run the algorithm. Step 1. Identify the transaction. An enterprise fund is billing a general fund. Step 2. Is there an exchange of value? Yes, water service is being provided for $30,000 cash. Therefore, the classification is an inter-fund service. Now for the accounting impact. The enterprise fund, acting as the seller, debits due from general fund and credits revenue for $30,000. The general fund, acting as the buyer and being a governmental fund, debits expenditures for $30,000 and credits due to enterprise fund. Now look at the government-wide treatment. Pay close attention here. This transaction is not eliminated. Eliminating it would understate the water utility's total revenue and simultaneously understate the general government's true cost of operations. Internal transaction logic dictates no change in total resources, and classification depends strictly on this exchange of value. Therefore, interfund services survive the consolidation process.
Scenario 2. The City of Fairmont General Fund initially paid a $25,000 cost that properly belonged to the Enterprise Fund. The Enterprise Fund is now transferring cash back to the General Fund to correct the entry.
Let's execute the algorithm. Step 1. Identify the transaction. This is a $25,000 payment to correct an earlier entry. Step 2. Exchange of value. No. Step 3. Is it correcting a prior transaction? Yes. The classification is a reimbursement. Accounting impact. The enterprise fund debits expense for $25,000 and credits cash. Again, it is critical to lock in the proprietary fund's record expenses, never expenditures. Meanwhile, the general fund debits cash for $25,000 and credits expenditures to reduce the initially incorrect charge. Why do we credit expenditures instead of recording revenue? Because the general fund did not earn anything. It is simply taking back a mistaken payout. Recognizing revenue here would overstate the general fund's operational inflows. Government-wide treatment. This transaction is eliminated in consolidation. Both internal entries are removed when combining activities, leaving only the final expense recognized within the enterprise fund that actually incurred the cost. Again, an internal transaction means no change in total resources. Classification here depends entirely on the correction.
Scenario 3. The City of Fairmont General Fund moves $90,000 to the Debt Service Fund to cover annual bond payments. No repayment is expected.
Execute the algorithm. Step 1. Identify the transaction. A $90,000 one-way movement of cash. Step 2. Exchange of value? No. Step 3. Correcting a prior transaction? No. Step 4. Repayment expected? No. Step 5. Otherwise, the classification defaults to a transfer. Accounting impact. The general fund debits other financing uses, transfers out for $90,000 and credits cash. The debt service fund debits cash for $90,000 and credits other financing sources, transfers in. Because this is a transfer, it goes strictly below the line on the governmental fund operating statement, completely separate from standard operating revenues and expenditures. Government-wide treatment. This transaction is strictly eliminated. The transfer simply moves resources within the same government, so it does not represent true revenue or expense at the government-wide level. An internal transaction equals no change in total resources. Classification depends entirely on the lack of exchange, correction, or repayment.
Scenario 4. The City of Fairmont General Fund provides $60,000 to the Capital Projects Fund, and repayment is explicitly expected.
Execute the algorithm. Step 1. Identify the transaction, a $60,000 movement of cash between funds. Step 2. Exchange of value? No. Step 3. Correcting a prior transaction? No. Step 4. Is repayment explicitly expected? Yes. The classification is a loan. Accounting impact. The general fund debits due from Capital Projects Fund for $60,000 and credits cash. The Capital Projects Fund debits cash for $60,000 and credits due to general fund. These are strictly balance sheet movements. They are assets and liabilities only, and they never touch the operating statement. Government-wide treatment. Internal receivables and payables are eliminated completely on the government-wide statements. If you did not eliminate these, the government would be artificially inflating both its total assets and its total liabilities by $60,000, creating a highly misleading balance sheet. The internal transaction results in no change in total resources, with classification strictly dependent on the expected repayment.
Section 6. Exam focus. Avoiding common traps. We're now transitioning to specific exam focus areas. Remember, all interfund activity follows the exact same classification logic and does not affect total government resources. The CPA exam tests classification, not complexity. The decision framework we just covered is the primary tool to unlock any simulation you face. Speak this logic to yourself during the exam. The absolute most common error candidates make is confusing transfers with reimbursements. You must strictly enforce the definitions. A transfer is a non-exchange movement of resources. A reimbursement is exclusively a correction of a prior accounting error. Don't mix them up. Furthermore, remember that a loan is never a revenue or expenditure, and that interfund services are the one general type of activity that is not eliminated. Interfund activity is internal and does not change total resources. Correct classification depends on exchange, correction, and repayment. Services survive elimination, loans, transfers, and reimbursements do not.